Hello investors. The last 6 months have been difficult. The markets have been on a downtrend. And in that, the last 2 months have been even more painful because the index optically has looked bad, but definitely stocks have fallen a lot more. So today I'm here to address this issue. I get calls from clients and friends. The first question that they ask you, the more worried one of course, is the bull market over? Is the bull market over in India? Well, some ask that even, is this a correction? Is it an opportunity? So I'm here to address the issue that is the bull market over, or is this a correction in a larger bull market? I'm going to address this through 3 ways. First, we will discuss global markets. Then we will discuss Indian markets. And thirdly, more specifically, that what are the sectors and themes that are emerging which we feel can emerge from this fall, which also could be very big opportunities for you and us. First, let's look at the mothership. What you are seeing on your screen is the S&P 500. The S&P 500 is the top 500 US stocks by market cap. And these price movements you see are for 5 years. Why I have taken 5 years is because that's just about where the COVID fall happened, which you can see at the bottom left of your screen. And this is when this bull market, which is almost 4 to 5 years old in the global sphere, is playing out. So what you see is a very good move in 2021 all the way to 22. 22 we had the Ukraine war and there was a very big commodity spike, which led to global markets and especially the US correcting. Post that, it emerged from this fall in late 23. 24 has been a good year. The important thing to take away is that in the boxed area that you can see on the right top, in the last few months, you will find that the US continues to make lifetime highs. And that is very, very significant. In the last few months, there's been a lot of uncertainty due to Donald Trump, the tariff issues and a lot of other issues. But in spite of all that, you'll find that the US markets continue to be in fine form. So as such, there is no panic with the most important market in the US, which is 65% of the global market cap. So the first thing to realize is that globally, the most important market in the world is showing no red flags. Next, we move to the next important geography, which is Europe. This is the Euro Stock 50, the top 50 stocks in Europe. Similarly moves post-COVID. Again, 22 was a sharper fall because Europe was in the forefront of the whole Russia-Ukraine war. But post that, surprise, surprise, you will find that even European markets, in spite of all the tariff issues, in spite of all the NATO issues, continue to make lifetime highs. This is about 15% of market cap. So 65% is US, 15% is Europe. That's 80% of the world is pushing to lifetime highs. The third I want to share with you is something which may not be such a large geography in terms of market caps, that is China. A lot of people have been saying that, hey, you know what, money is moving away from India to China. But if you look at the Chinese market, yes, they had a rally post-COVID, but they have not been able to take out those levels till today. So I for one think that the Chinese markets are having a technical correction, but they seem to be in a larger downtrend, and I don't think that the whole money from India is going to move to China. These are opportunistic trades which have happened in the last few months. However, there is no trend reversal or trend change in China that I am seeing. And that is very important to understand and put to rest that the FIs are going to leave India lock, stock or barrel and move to China. Once we've had a look at this, this table shows you the returns in 2025, which is about just over 2 months. Why, as I said, the last 2 months have been very difficult months for investors. But in this, you will find that there is more green than red. In fact, a lot of markets have moved up 15-20%. And in this, India's kind of ranks at the bottom. So, as far as the world of equities go, there is no big global sell-off or risk at the moment. Global markets are pushing to lifetime highs. India specifically is correcting. And why I think it is important to understand this is that whenever I have gone back and seen in history that Indian markets have had a big fall, a big crash, which people are fearing, it's not happened so far, it has always emanated from global trends. Whether it was the 2000 IT Nasdaq crash, whether it was the 2008 financial market crisis or the 2020 COVID, these falls were global in nature. And what you are seeing in this fall is that this fall is specific to India. And in front of you, you can see that most global markets are pushing to lifetime highs. Yes, India has had a few months of underperformance. Now we get a little deeper and start looking at a few other asset classes. Two other asset classes are very important because they have a big impact on equity. One is commodities. If you look at commodities also, because the whole 2022 issue was caused by commodities, and here the most important commodity for India is crude, Brent. It's our largest import bill, and if crude really goes up or takes off, it can trip India's growth story. In front of you, you have the Brent crude chart for the last 5 years. You will clearly see that there is no rally there. In fact, Brent is threatening to break out from the lower trend line. If the whole Russia-Ukraine thing settles or if the Middle East cools off, you will find that maybe crude will dip lower, and this becomes a more compelling case for India and good for the Indian economy. The second is US bond yields. Again, an elephant in the room as far as global asset classes go, but post the rally from 20 to 23, 24, you will find that yes, you have up and down days, fear of inflation, etc., coming day to day. But here also there is no red flag. There is no red flag. Next is the dollar. We have seen that the dollar has appreciated in the last few months, especially post-Trump's victory. But post that, you will find that even the dollar is correcting. The dollar, which had moved above 106, which you can see on the screen, has dipped below that. So what I'm trying to tell you is that essentially, if you look at most global asset classes and equity markets, there is no crisis anywhere. There is no red flag. The fall in India in the last 6 months is very, very specific to India. And that is why we feel that this is not going to be a large correction. The bull market is not over. If for a bull market to get over, there has to be a very big global sell-off, which is not there. This is just a correction that is happening specific to India. That's why I call it a technical correction in a larger bull market. And now we really need to understand this, because in my view, it is not a point of panic, but actually it is a point of opportunity. If we get an understanding as to how deep the fall in India can be, one, that means which is a point where you can allocate more, and number two is what are the sectors and themes that will lead the pullback. I feel that this current crisis can actually be a blessing in disguise. I know the short-term pain is there. I know you may think that because I'm a fund manager, I have to always talk bullish, but this is what I see in terms of data, and I'm equally invested in the market, or probably more than you are. What you see on your screen is the Indian markets. This is the Nifty 50, and this is only for 18 months, the last 1.5 years, because I want to get a little more granular and not look at just the bigger move and understand the last 6 months. So you can clearly see from September onwards, the Indian markets have been on a downtrend. The index has fallen around 16%, the Nifty 50, the small and mid caps have fallen more. But where I think that we could have a bottom in place, again, it's a very, very difficult thing to say. In fact, it's a thing where most people would fear to call bottoms, but I just feel that I need to share with you what I think is where the market can bottom out. I feel that we have a very good pattern formation, which is very visible in this whole shoulder head shoulder kind of play. I feel the first support for the market is around 21,800, which it has kind of probably recently hit. The next big area which I feel could be the very, very strong support is around 21,300. So I feel that we are in the last leg. As I said, it is very difficult to call the exact point, but if you look at the circumstantial evidence, I do get a sense that we are somewhere near the bottom. This is what the chart patterns are giving me as targets. If you look at the lower panel in this particular chart, you will see that these are oversold, overbought indicators. And clearly you will see that the Indian markets are extremely oversold. Extremely oversold. If we move forward to the next chart, this is a very simplistic way of looking at things. This is something called the 200-day moving average. You must have heard it below. When a stock is above a 200 DMA, it is considered as bullish. When a stock is below a 200 DMA, it's considered bearish. So if you take the Nifty 500, the NSE 500, you will find today that 85% of the stocks are below the 200-day DMA, which tells you that the market prices or the market mood is extremely bearish. And if you go back in history, which you can see on your screen, this is the chart for the last 20 years, you will find that every few years, the market reaches these points of extreme pessimism. And whenever that has happened, the pullbacks have been sharp. At this moment, we are at almost, as I said, at a count of around 14, which is well below the 80% mark. So what you will realize is that Indian markets are extremely oversold. As I said, it is very difficult to call the bottom. I have made some attempt in the earlier slides, but the risk reward at such points on time is extremely favorable for a sharp pullback. And that's the kind of opportunity we feel investors have. Why did this happen in India? What happened? Why did India stand out for a market that's doing very well? What is the reason for this technical correction? What you can see is the valuations. So you've been hearing that Indian markets have run up, and when markets run up, they do get expensive. And whenever markets get expensive, there is a bit of selling that comes in. So here you can see the price earnings ratio. The 5-year median is in the first year. That means this is the historical 5-year PE. The peak PE that was there, that means in September, what was the PE? So you can clearly see the Nifty 50, mid cap 150 and the small cap 250, which is all were at a premium. And the premiums in small and mid caps were larger. However, post the correction, you will realize that a lot of these have come below their 5-year median. So what was expensive, what seemed like a bubble, due to its current correction has come down. And that, I feel, is the nature of technical corrections. See, when there are structural corrections or when there are primary changes, it is due to some reasons. When COVID happens or some very structural issues, these are just excesses created by humanity, and those excesses get corrected with time. With time and with price, you will notice that what is expensive suddenly looks cheap. And that is why I think this fall is technical and not structural. If you look at it, what has gone wrong with India in the last 6 months? Politically, nothing much has changed. In fact, the government's got stronger after the Delhi victory. The Indian macros are holding. Commodities and crude, which have always been the Achilles heel of India, has in fact breaking down. And in this environment, India specifically has no reason to be sold off so aggressively. The reason you see is nothing, that things had moved up, there was froth, and that froth had to settle down. Whether you see it in PE valuations or you see it even in IPOs. A few months ago, you almost had an IPO a day. Just look at the condition and look at the damage that has happened. Out of the top 10 IPOs of 2024, 9 of them are below the listing price. Mind you, listing price and not the IPO price, because at the IPO level, they were so heavily oversubscribed, hardly anybody got subscriptions. Most of the volume happened post-listing, and 9 out of the top 10 IPOs, the largest IPOs, are actually below their listing price. And that really explains to you that wherever there were excesses, they are getting corrected. If you get into stocks also, you will find that a lot of stocks have fallen 60-70%, and these were the darlings of the retail HNI margin funding crowd, and that space is getting corrected. You will see that there is really no let up in the mutual fund flows, SIP flows. We are not seeing any major redemptions. In fact, we are seeing inflow from clients who are using this opportunity to top up. And that, I think, is a very positive sign. The froth, the bubble, the leverage in the system is actually getting corrected. And that, I feel, is a very, very positive sign. If you look at sectors, as I said, we would end with this, that what sectors and themes are holding out. You will clearly see that the sectors that are holding out in this fall, or sectors that have fallen less, tend to be leaders. They are clearly private sector banks, financial services, pharma, metal. These sectors have actually fallen less. And we believe that sectors that fall less in a falling market are finding buyers. And when the market reverses, this is where leadership will go. In our PMS, these are the spaces we will be deploying to. We also feel that we are sitting on some cash at the moment. We will use this fall to actually accumulate some of these stocks, the stocks that we like and which are available at very good prices right now. Small and mid caps, again, another episode is required for them, and hopefully we will cover them next week or next month. But I just want to end with this summary that we are in a larger bull market. Nothing has changed globally. Specifically, India has fallen because certain excesses had played out here, whether it was the retail leverage or the IPO space. That space is actually hurt the most and things have cooled off. This is a technical correction in a larger bull market, and if as an investor you have cash and conviction, this is a great opportunity to invest. I just want to end with a beautiful line which you must have seen many times, a lot of posters on the wall, the great Warren Buffett. Be fearful when others are greedy, and this is the time. Be greedy when others are fearful. Fear is highest. The question is the bull market over? Is nothing but an expression of fear, and this probably is the time for you to be greedy. Yes, these are challenging times. We are going through difficult times, but we have seen this many times in the past, and we think we will emerge from this much stronger, and the recovery will be equally spectacular. With that, I leave you for this month, and keeping my fingers crossed and keeping the faith in India and the big Indian structural story. Thank you very much.